Good morning and welcome to the Flow Show, everybody. Just want to do a quick mic check, if I may. Can you hear me okay? And is my volume okay? Some people saying it's a bit quiet yesterday. I'm trying out a new mic. Just want to make sure it's all good. Fantastic. Thank you, Brian. Right, we shall kick on to the news headlines then. Get straight into it. Thank you, Giuseppe. China is likely to cut its reserve requirement ratio in Q3 to boost the economy, according to the China Securities Journal. It was touted that it may come sometime in Q2, but it seems like they're going to give it a kick to Q3. They have announced some other measures, consumption boosting measures, which isn't being classed as major stimulus. They're trying to support companies to develop green, smart and age-friendly household products, and want to encourage homeowners to upgrade the insides, decorate, buy new stuff, just to give consumption a boost there, and offering incentives for that. Deutsche Bank have joined the throng of China GDP forecast cutters. They now see GDP at 5.3% versus 6% previously, which is still a bit higher than everyone else who have gone to 5%, but still downgrades in growth forecasts there. Over to the RBA and what could possibly be construed as hawkish comments from the minutes there, saying that some further tightening of policy may be required. The board considered holding rates steady or hiking by 25 pips, so a little bit more on the fence regarding what the decision was there, closer than maybe some had thought. The board agreed that some further tightening may be required and would reconsider that at the August meeting. So that's now made August a live meeting for a possible hike. It just sounds bonkers to me. These guys hiking 1 month, pausing the next, hiking the next, pausing the next. You can't decide monetary policy like that. You can't even see the effects of monetary policy that quickly. So no idea what these clowns are doing. They did say that the current stance of monetary policy was clearly restrictive and would become more so. So potentially not at their top, although RBA's Lowe was out saying that he saw rates pretty much at the terminal rate of where they are now, so we can see what side of the fence he's on as far as the hike cut cycle goes. But as far as the rest of us, clear as mud from those guys. Aussie dollar not really doing much at all on that. Was a little bit stronger as that came in, but we're really sitting in a range still holding, give or take, this 68 handle. Had a little dip under below, but holding it for now. Let's see what happens with this one, whether we carry on going sideways or we have another look higher. Anyway, over to Germany, and the Bundesbank says that they've already thrown their June forecasts in the bin, saying that GDP recovery may be weaker in the remainder of 2023 than implied in their June forecasts. Good forecasting again from those guys. German inflation may fall further in the coming months, and the core is to stay very high over the summer. You may recall the last inflation number we got out of Germany was a high print, took inflation higher up. That was due to some effects washing out from last year's transport subsidies that they put in place to cheapen travel for Germans and people in Germany. That is likely, that could stay in the pipe for a bit longer, i.e. we see another report higher, or it could wash out pretty quickly, but we'll see what happens with those next numbers. Some hope for BOE's Bailey, because UK food manufacturers apparently cut prices for the first time in 3 years last month, according to a survey by Lloyds Bank. So that will bring some relief to the BOE if it impacts inflation. I'm still maintaining that this CPI report may not show things like that coming into the inflation picture just yet, and I still think from next month we may start to see that effect happening. Nothing's guaranteed, of course. It could be a bit later, or maybe we get something next in tomorrow's reading, but I'm not so sure, as there's still a lot of wage pressures in there. Over to the ECB, and Visco says that manufacturing is slowing, but services like tourism is booming. Obviously, we've seen that in the recent PMI data. Striking a bit of a cautious note, saying we have to be careful about doing too much. Talking about further rate hikes. Says that a drop in energy costs is to show up in core inflation. Well, you might be waiting a bit longer for that, because a French government official confirmed that there will be a 10% electricity price hike for households from August. So this is going to hit, obviously, inflation in August in France in particular. I think this is probably a bit of washout of energy subsidies that have been going on across Europe. So as those come to an end, prices are going to adjust back higher in the main, unless prices have fallen back enough to see them coming down. The UK, July, had a price cut for energy prices kicking in at the beginning of the month, so that's something that's going to feed into inflation. But as far as Europe is concerned, and France, a 10% hike in electricity prices is going to feed into inflation. ECB's not out with some pretty dovish comments for someone who's one of the top hawks at, on the Governing Council. Says it looks like core inflation has plateaued. Is optimistic to see inflation hitting 2% in 2024. Will need to hike again in July, but more hikes shift the balance of risks towards doing too much. So echoing a bit what Visco has said there. Hikes beyond July are possible, but not certain. That hit the euro a bit when those comments dropped. As I say, he is a big hawk. So talking about inflation plateauing and likely to hit 2%, and seeing the balance of risks of doing too much, all a bit dovish for him. It remains to be seen how many others share his view. There's always hawks and doves, and the hawks have been winning out. That's likely to have drawn down September hikes a bit at least, but we're still seeing pretty much on for a July hike, no change there. The ECB has had a warning for good old Deutsche Bank. They're back in the news, saying they have to improve their FX oversight and checks. They found some issues going on in the back offices or wherever at Deutsche Bank, and if there's ever a bank that always getting ticked off, it's likely to be Deutsche Bank. So no real surprise from that. Coming over to the US, the only real bit of data we got yesterday was from the Empire State Manufacturing, which came in better at a positive 1.1 from minus 4.3 expected. So not seeing a drop back there. In the details, not on the calendar, employment rose to 4.7 versus minus 3.6 previously. So good news for the jobs market. Prices paid, so a bit of inflationary pressure, dropped to 16.7 versus 22 prior. New orders was little changed at 3.3 versus 3.1 prior, and expectations for the next 6 months came in a bit softer, 14.3 versus 18.9 prior. So the first manufacturing number of the month from the US, and a little bit of an improvement there. This one has been a bit flaky of late in terms of how it's turned out. We've had ups, we've had downs. When it shows up, as you can see there, it's not really showing any signs of trending in particular, except that the down months are bigger than the up months. So that's a pretty much an indication of how manufacturing is going on. The next number we get is Philly Fed on Thursday, so that'll give us a second clue. And then obviously next week we get stuck into the PMIs once again. Some news that might be concerning. Ford has cut prices on its electric F-150s Lightning pickups by as much as $10,000. This was picked up by CNBC, and the reason given is they it's just a competition move against the likes of Tesla and other electric vehicles. For me, it's something we need to keep an eye on. I've spoken at length about how inflation patterns work, and we've had obviously a big inflation push, seen prices rising, got everyone across the board hiking prices. If that starts to hit demand, i.e. people aren't prepared to pay those high prices, it stops spending. Suddenly you get price cuts. Depending on the size of those price cuts, determines whether you hit a disinflationary cycle or a deflationary cycle. So cutting 10 grand off of a vehicle is a bit of a hefty price cut, even if you're competing against others. The problem for firms like Ford is that because input materials have been so expensive over the last few months, they would have been building up inventories at high prices. So cutting prices now decreases their profit margin. If they're forced into a cycle of chasing consumers by lowering prices further, they're going to wheedle out their profits even more because those high input costs are still there. Only when you start to see input costs really coming down, then you can keep your margins. But it can mean that we enter a sort of mini deflationary spiral, i.e. lots of price cuts coming. So one swallow doesn't make a summer. I'm not going to get too excited about one headline like that, but watch if it starts becoming wholesale, i.e. we start hearing of normal retail companies, Walmarts and Targets and all else, Amazons, all chucking up price cuts to try and chase losing business. And that's when central banks will sit up, because it can mean a real steep fallback in inflation. And that's when the rate cuts will start gaining ground. Anyway, some other bad news for the consumer. And again, this is coming on top of, as I mentioned, US savers drawing down savings at an alarming rate. Well, now more Americans are getting turned down for loans, according to Fed data. They say that the rejection rate for loan applicants jumped to 21.8% in the 12 months through June, and that's the highest level in 5 years. This falls into the tighter financial conditions. Rate hikes have gone up. Firms are being more cautious about lending money to individuals, to consumers, because they fear their inability to be able to pay it back. If you start limiting credit, people can't borrow, people struggle. Again, consumer spending dries up. Again, it leads to firms chasing consumers lower in prices. It all becomes a bit of a snowball effect. So this is now two or three things that are waving some mini flags for the US consumer. If that develops into something more broad, then the Fed have got a problem on their hands. Something for you stockies. Apparently US funds have hit their limits on holdings of big tech stocks. There are diversification rules among some asset managers that stop them from buying more shares in companies. Some of these have obviously been the dominant forces in the recent stock market rally. So they have allocations and limits of how much stock they can hold, or value of certain stocks, and they've hit their limits. That means they can't buy any more. If that's the case, then you're losing a big chunk of liquidity holding up stocks in the market. I'm not saying stocks are going to puke on the back of this news, but depends how widespread it is. If a lot of the big companies are losing that bid, it's up to the little man to keep it buoyant. And if they can't, if they don't have the money to, you're going to see some sort of pullback. Right, geopolitics. And obviously we had news of Ukraine attacking that bridge in Crimea, knocking out a good chunk of it, leaving apparently one lane in use. Putin came out saying that what happened to the bridge is a terroristic act by Ukraine and that Russia will respond. Pretty much straight after that, they pulled out of the grain deal. There were talks ongoing as to whether it be renewed or continued. They put a block on that, saying no deal, nothing's happening, we're stopping the grain deal. And then overnight, or this morning, they attacked one of Ukraine's grain ports. with drones and missiles and whatnot. So a bit of a step up in what's going on over there, a bit of tit for tat. Obviously, the Ukraine is in the midst of its counter-offensive, and some are now saying that Russia is responding with an offensive on its own to counter the counter-offensive. Either way, things are scaling up a bit on that front. We've still got this bubbling situation with the US potentially sending cluster bombs over there, and Russia repeating that they will respond in kind, even though some suggest they're doing that already. So just keep an eye on those headlines as usual. The market sailing through, not giving too much of a care about it. Dale's probably going to be interested in this one on the Face Show because he takes a big look at grains and stuff, and this is obviously going to impact that moving forward. Turkey, however, are still a bit in the mix, with Erdogan saying that he might be speaking to Putin about grain movement. So the saviour, as he likes to call himself or promote himself in these things, might be coming to the rescue regarding grain movements. But again, if that is something that's going to put pressure on foodstuffs, that's more inflation coming in the pipeline. That's all I've got for today. What we need to be looking at in today's data, again, not really an awful lot coming out, but we do have some CPI data from Canada, and retail sales, of course, from the US. Nearly missed those. So two decent numbers there, one for dollar, one for the loonie. Retail sales, again, I'm getting a bit worried about the consumer at the moment. I'm not sure if anything shows up in these numbers. The second quarter has been pretty okay on the consumer front, but we will wait and see what the numbers are here. Expected to come in at 0.5% on the month. Keep an eye on the control group number here, retail control, expected to drop to minus 0.3%. This is, they've got two numbers here, core and retail control. Retail control is more a core number than that core number, if you get my drift. So that's the one that most people look at, the control group. So that's expected to dip. Not looking at any huge numbers here, no big percentage swings. So that's the risk for this data. If we do get a big out there number, be it a gain or a miss, that's going to swing the dollar, going to play into the soft landing and what the Fed do, expectations for July and thereafter. So keep an eye on that one. As far as Canada is concerned for CPI, expecting a further drop to 3% from 3.4%. This was something that I thought might tip the BOC into a pause at their last meeting last week, because that number 3.4 was a big drop from 4.4 the month previous. I thought that might be something that would push them more towards a pause, but they went and hiked. This number, again, if we're looking at a two handle now, we're getting down to the BOC's target. 3% is the top of the BOC's target. They want I think it's 1 to 3% target range for inflation. They're not a one number bank. So getting to 3% will put them bang on their target. Anything less, and again, we'll probably see pause expectations increase for the bank. They also like to have 30 goes at trying to guess the core number. We have the mediums, the trimmed, and the this and the that and the other. So just keep an eye on those core measures. Keep an eye on the BOC core as well. Is it on there, BOC core? No, let me just double check that. That, I think, is the BOC core, which is 3.5% versus 3.7% prior. So if you're trading the CAD on this one, obviously, if we get a super strong number, that's going to increase rate expectations for the next meeting. Like to see CAD gain. Conversely, softer numbers coming in lower than on any of this, we're likely to see CAD pairs rising as those expectations for another hike dissipate. So keep an eye on that one. Industrial production, not really a market mover these days, but again, just look for any big out the moves from this one. It is a bit lagging, this data. So manufacturing, we know, has been in a bit of a slump. So probably not going to see anything too much on the upside regarding these numbers, but might be give us something to trade later on this afternoon. As you can see, a couple of Fed speakers here, but they're speaking about other stuff other than monetary policy. And lastly, a bit of housing data, the NHAB housing market index, which has been showing a good solid improvement over the last few months. And when the chart pops up there, as you can see there, we had a real slump in the latter part of last year, but it's been improving as we've come in to this year. So let's see if that run can continue. Right, that's it from the headline front and looking at the data. So let's have a look what's going on in the prices. Ali, he's short Aussie dollar at 68.17 with a stop at 57. Okay, so you're in just below these highs, and your stops up above the 50 area, which looks sensible. Bit of a on-off point in that one. Your TP is where 67.87. So you pretty much bang on that low. So you want to think about that. First of all, you need to get under 68. It's looking a bit similar to what happened in dollar yen. We came down to the 68, then we had a little break under, then we've started to hold it again. So if you get a move, secondary move under 68, you might get your profit target there. Just keep an eye on that low. It just comes in around a little bit of former support and resistance area down here. Short-term stuff going back to last week around the 80s. So just keep an eye on that one. You may want to think maybe just taking a little bit of profit ahead of that low, just in case buyers are sitting and waiting and protecting that low. You don't want to get to 80 or 83, not take some money off and find it bounces from there and you've missed out on getting any money. But your trade is your own, my friend. So, you know, you manage it as you see fit. That's purely what I would do, just to make sure, just in case you don't get your target, you don't want to miss out on any money. Better to make some than none, as I like to say. Right, let's go quickly around the grounds. Euro dollar was sailing pretty strongly this morning until we got ECB's not, who put a bit of a torpedo in it. Not a huge pullback. We've just basically gone back into the consolidation range that we've seen recently. This one's still coiled quite tightly. It looks, you know, we've had a big strong move obviously throughout July. Now we're just maybe running into a bit more tougher selling on the upside, or pressure on the upside, not allowing the price to move any further up. These are sort of signals you want to be looking for when you're trying to pick tops and bottoms. We are showing the ability that we can still make fresh highs, but as I say, the rate of ascension has markedly slowed. Could be just a sign of the market taking a pause before all the central banks next week. Obviously the ECB being one of them. So maybe we don't want to see, or maybe some traders don't want to push the boat out too far further than they already have in July so far. Support, looking at 112 big figure really is the main support there, maybe down to this trend line, which is an age-old trend line. Just give you a quick flick of that so you can see that one. So this trend line is going all the way back, way back to the early 2000s. So big old trend line. Didn't really do much on the way up, but it's one of those ones where, you know, it may have a saying things on the way back down again. But 112 is probably your main level regarding that one for now. But I don't see any reason why this is going to collapse any which way. On the other side, I'm still looking, our main level above is still when we get into pretty much into the close to 114. Let's see if I can get that a bit clearer. So my big level is 115, but the traffic always starts around 114. You can see we've had loads of touch points all the way along. So it's a big old zone. I'll probably have to get my colouring pencils out and make this a bit of a zone. Between 114 and 115 is going to be huge. There's obviously some little bits and pieces as well. 113.5 is another level that tends to show up. Again, one of those ones if we haven't been there for a while, probably on a first touch, you're going to see some action there. Maybe a little bit of a pullback, but if it goes, then we're into this big zone. This is about the only area I would consider taking some decent shorts, purely on a technical basis. I'll have to see what news is driving us there, but it is a big, huge level that goes back absolute years. So this is a bit like your 145 in dollar yen, but even bigger. So these ones are on my radar. Whatever it does in the middle here, it can faff around to its heart's content. But 115 or getting into 114s, I'm going to be looking very closely at that. Dollar yen. Let's bring it down a bit shorter. Let's go to an hourly. So we had a little bit of a spike up above 139. I did some pips yesterday, just trying to see if the break would hold. I bought it 139.05 with a tight stop at 90. That got taken to the woodshed. So despite that little spike above, we're still not ready to push and hold above 139. So it's no real surprise that we're back down here towards 138. That held yesterday, but as I always like to say, I don't like it when a price comes back to a level too quickly. What I would say though, and what I've been watching for, is we are doing the old step up. So we made this low, made a high, made a low that stepped up from this low, made a higher high. So it keeps these, you can see we've got a little bit of an uptrend perhaps developing. Very short term, you're not going to put the farm on anything around here. If we hold 138 again, if we hold just above 138, that may possibly indicate another step up. So then we're seeing a third higher low. That might suggest that we get another move above 139. But for me, it does look a bit more finely balanced here. No one's ready to push the boat further down. Sellers aren't ready to throw the towel in up above 139. So we've still got a few questions going on here as to which way we're actually going to go. If we do hold down here 138, that's really going to solidify the line. As I say, we probably would get another move through 139. But if we come back a fourth time to there, I'm going to be worried that we get a break. If we get a break, then this low might be in trouble as well. So lots to be decided in this one. Again, Bank of Japan next week, so we might find we have a little bit of a sideways action, and I wouldn't be surprised if maybe we ping pong between these two highs and lows, and we just we wash out this pattern of high highs and high lows, and it just becomes a bit of a mess, just a bit of sideways action. So just be prepared for that. But you want to see, if you're going to get a move, you want to see 139 taken and then holding as support. Get that. Perhaps you're getting more 140s, 141s. Same on this side. Get below 138 and it starts holding. We're likely to put in a test of these lows once again, and then we'll see what happens down there. But for me, I'm neutral over the direction of this. You know, you can take things in two contexts. We've got a downtrend since the 145s, but we're not quite yet breaking the bigger uptrend. We've tested, got to the 50 fib, it's held, significant move because it means the trend isn't yet breaking. It looked like it was breaking, doing the 38 fib, the 50 fib is another line in the sand, break that, and then we've got something on. Your 61.8 is the final line in the sand. That's how I use fibs. And obviously don't forget, we've got these moving averages down here as well, around the 137. So technically, you know, I was highlighting this when before we had this move, that this would be the next stronger area under 138, and thus it's proved to be. So lots can happen here, and we keep an eye on it. Looking at the CAD, because we've got that data coming up today. Again, this one is just a bit messy. You could say we've broken a bit of a wedge going on here. We have perhaps got a bit of a downtrend going on. You know, we had the low there, now we're getting further lows. The bounces aren't looking too strong. We had one bounce to 134 that was decent enough, but again we came back down really quickly and then made a new low. We're looking like 132 is becoming a bit of a pivot point. While we hold below, keeps the downside on. If we do manage to get above, then perhaps something more can happen. But at the moment, 132, we're just deciding whether we want to be above or below it. So again, it's being a bit pivotal. I have been eyeing this 130.80 area, though I have a feeling this move here might have been it. Obviously, I was being greedy, trying to get an entry in. We got down to the 90s. I'm being a dick for a pip. Rather than getting in now, I want to wait till we get to 80s. But I think if we do get another move down here, I'm not sure that level is going to hold on another attempt, because we are just, as I say, making lower lows. And if we fail here, we're likely in for some more downside. And I'll have less conviction in trying a long off there, because a break could mean we're heading further south. Anyone got anything they want to talk about? Put it in the chat function, please. Horatio wants to look at Aussie CAD. Oh, you do like picking them, didn't you, mate? Right, let's have a look. I don't even know if I've got it on here, Aussie CAD. Have I got it somewhere on here? No, I haven't. Oh, was that down the bottom? No. So let's have a look at Aussie CAD. You guys do like picking them, your charts, don't you? Oh, look, I've got some text on here anyway. Let's see if those need a bit of updating. We can do some live charting as we talk. There we go. So that fib can go, because that's all finished with. Get rid of that, and we can chuck one in here. There we go. So what are you looking to do in that one, Horatio? You're looking to get long on a CAD CPI miss. Looking at this, we're right, or been very close to a decent resistance area. The 38.2 or the old 38.2 fib, depending on how you're judging it. I don't like this move in the middle with regards to fibs. Had that discussion with Blake the other day. But anyway, we're here. That's your resistance area. It's been a former support point, former resistance area up in this 90s and a half. So if you want to grab long on a data miss there, you know where your trouble point is. If you're not going to get through there, you're going to need to think about taking profit into that area. Conversely, if you do break it, all well and good, but you want that to hold a support straight after. If it doesn't, then it's likely you can just a little data blowout, and if the move comes back under, then we're going back in the range. Support pretty much stands for itself down here at the prior low, around the 87.5 number there. Look at these highs as well. If you get above this 90.5, you do get a bit of resistance into 91s. Obviously, then you have the fib just above there. So you've got 2 or 3 levels in that to keep an eye on. You know what the price is going to do. If you're long, you know it's got to get above here. If you can't get above here, then you need to decide what you do with your trade on that one. And he's asking what can put the dollar back into fight. ECB dovish, Eurozone data, oversold conditions. You mean what can have it the dollar getting stronger? The main thing, and as I've said the last couple of days, the main risk for this dollar weakness is the Fed coming out and talking tough about rates and keeping rates higher for longer. As we've been mentioning there, the market has written down Fed hike expectations. We're still pretty much nailed on for a July hike, but a second hike after that has been pretty much washed out. Also pricing cuts for next year. We've been here before. We've been here when the market has tried to pick a top or tried to put the Fed's message to the test by saying, nope, you're going to be cutting sooner than you think. And every time Powell's come out and stamped all over that. The thing is, it doesn't matter if Powell comes out and stamps all over it, but he's wrong. if he's wrong this time, if rates come down sooner than they expect, if they don't stay high for longer, if they're wrong about this, it's fine, because it means that inflation has gone where they want it to go. They have succeeded in what they wanted to do, what they set out to do. This is different to being wrong when they were saying there was no inflation and inflation was transitory, because that brought a lot of pain. So they can afford to be wrong on this side. That's what you've got to remember. So he could give a message that they're going to hike 10 more times. It doesn't mean they will, but they have to keep the message, the hawkish message in, that, because that's having the effect of bringing down inflation. That's tightening financial conditions. That's putting the squeeze on the economy, of which is looking like soft landing more than crash landing. And if that happens, then inflation comes down and it's win-win for the Fed. But they can't allow that to be undone by letting the market get too dovish. So what can turn this around right now? It's a strong sounding Fed next week. Of course, the data can do that as well. If we get a real bumper retail sales report, we know we're trading data dependency, so that's going to bring another rally in the dollar. The problem we got is, does that last? Because over the last couple of weeks, we've seen good US data and the dollar's been sold after it, because the market is trying to trade the end of the Fed hike cycle. So in the meantime, you know, you don't, if you're asking because you want to get long, you can be long anytime you like. You've just got to know where your trouble points are, where your risk is being long the dollar. You know, depending on where you want to be long the dollar, you pick your levels. If you want to be long the dollar, you know that you're looking at 138s and the prior lows in dollar yen. If you want to be long the dollar, I would be looking at euro dollar in the 114s, 115s. You know, it's all right being long dollars, all right fighting the trend, as long as you've got a good reason to, and as long as you know the wind that you're trying to trade against and you manage your trade appropriately. So if you want to fight the trend, go ahead. Pick your levels, pick your battlegrounds, know your risk. You don't need to go as big a trade trading against the trend as you might do going with a trend, because the trend is on your side. But you can pick whatever pairs you want, but just know where your risks are. If you want to buy the dollar, you don't want to be buying the dollar 10 minutes before retail sales in case it's a crappy number and you get taken to the cleaners. So you want to maybe look to be playing more short-term trades, sniping as we call it. You want to get in a trade, fine, do it. If you see some profit, take some profit, lock up your stops. The only thing you need to do is get your risk to zero as soon as possible. That's the first thing I want to do with any trade, irrespective of which way. I want to get my risk to zero. Once I've done that, I'm on easy street, because all I can do is make profit or break even. Euro sterling was doing nicely this morning until Notters came along and shot it down in flames, the bugger. We had a sale up over 86, up to, this is a bit of an intermediate level, not something I'd really trade, but one of these levels that always, you know, does something. As you can see here, we couldn't get above, we've been above, couldn't get above, been above, support, resistance, blah, blah, blah. So we haven't been here for a few days. We pretty much tagged it and then Not came and shot it to pieces. This dip might be something that could get sucked up, but it seems like the wind has come out the sails of the euro a bit just now. I'm going to be looking at this one closely tomorrow for the UK CPI. Based on the price action we've had over the last couple of days and this move off of 85, I think this now, if we stay around here going into tomorrow, this will be a decent stretch point if we get strong CPI numbers from the UK. We may not even get down as far. We may only get down to this sort of area, maybe the 30s, 20s, something like that. If we get a decent move down there and we don't look like troubling this low, I'm going to add back into my longs and look to keep them on board for a while longer, because I've got the feeling that if we get strong UK data, good UK data, if we don't start seeing new lows made or highs in pound pairs, that's going to suggest the market is pretty much priced in terms of maximum BOE rates. And for me, even if that pricing is 6.5%, I don't think they're getting there. So the market's still to be disappointed. So I'll let the market mess around with its expectations, but I'm more inclined to now be selling pound strength on the back of those expectations. So for the CPI tomorrow, that's what I'm keeping an eye on. Whatever happens up here, I'm not too sure yet. We do have this zone 86, 45, 50, call it, up to 70s. Previous traffic zone, that's what we've got to get through for further upside. I've stuck in a fib this morning, so we got the 38.2 fib of this move from February. Now 86.60, oh, if I can read it, 86.85, which again just comes below another intermediate number around 86.90s. Big number is still 87.20. Big prior support and resistance point. We had it as support, we had a break, a bit of messing around, but not long after it became resistance, and we tried it a few times. So if we do get a move higher, that's my big number up there to look at. And if we break that, then I might consider adding to my long position, and then ideally I think we're probably heading up for another move to the 90s, or at least the 88s, 89s perhaps. And we shall see what happens, but all to be decided or not tomorrow. I've got a bit of margin in my longs, so I'm happy to sit in them. No real worries for me. Touch wood, as they say. Let's look at some of the other pairs, like have a look at Guppy, and then I'll have a quick look at Cable, if it wants to play nicely. So this one also, you know, staying up. The pullbacks aren't sharp. We did have a move to the 38.2 just of this leg, which is when we had a bit of a pause, and then we had a secondary swing up. But in the overall trend, as you can see, no signs of this turning tail or breaking just yet. The 38-point fib of this move this year isn't down to 174, so we're absolutely universes away from that at the moment. 182 is still being the thorn in the side for further upside. Again, another bit of a pivot area. We are getting little nicks above, but that's purely the volatility of the pair. But as you can see, on the way up, it was resistance, then we messed around, then it was support for a decent period, then we broke, then it was resistance. And thus, that is the resistance level at the moment. So this one's looking a bit similar to what we've seen in dollar yen. You know, a little bit of a breakdown, a little bit of a move up, stepping up slightly, higher highs, higher lows, but, you know, pretty much going sideways again. But this is what I love about trading, when you get defined levels like that, you know, and then on the downside, you get more defined levels. You know, it makes trading it easy. You're not trying to mess around in what's going on here. You're getting clear levels. That's all you need to trade. You either short it or you buy a break. And when it gets down here, you get out, or you look for a break, you go long, or you look for a break short. You know, markets only go two ways, up or down. It's a 50-50 bet, but you can increase your probabilities of making money by watching what the price action does and trading it accordingly. Doesn't matter whether I think the pound's going up or down, whether I think the UK is doing well or not. There's times you can just stick a line on a chart and trade it. But obviously you bear in mind where your risk points are, your data points and things like that, because you're not going to trade this line here if it's trading 180, 180, 5 minutes before the CPI. But you can trade it after. You can even get a spike to 183. If it doesn't last and comes back down under 182, you know that that's likely to be resistance again. Off you go again. You can trade your ranges and mess around in the middle after the big events. Right, anything else anyone wants to look at? As I say, you've all been a bit quiet. Come on now. You're not sitting there just listening to me babble on. Give me something to talk about, or I will just waffle on. Let's see how oil's doing at the moment. Holding up pretty well, not doing anything else after this dip back yesterday. So again, we're not sure what's going on. Market not sure which way it wants to go with this. I I am umming and ahhing about just having a little play here, a bit like I tried in dollar yen yesterday at 139, just to test whether this move is going to hold. But it's all short-term stuff, so I'm only going to do it for beer pips if I do. But it's not showing any real signs that it wants to make a quick return to these highs. So that tells me, you know, we've had a bit of pressure, a bit of steam let out the pipe on this one. I'm going to have a look at silver, because I know some of you guys like to look at silver, and obviously folks like Stel and Kay like to trade this one regularly. Banging ahead on this 25 area, not looking like it wants to go through in a hurry. However, the dips are pretty shallow, so it's keeping the upside pressure on. This is the sort of thing that if you wanted to be long but weren't long, you potentially look for a break trade. We did make that high 3 ticks over 25. You know, you could get a similar bit of price action to what's happening in euro dollar, where, you know, keep just nicking those highs. Euro dollar had that little move up to 1280 before getting knocked back. You might see a similar thing here. So if you want to try longs, look for a break of 25, maybe something like 25.05. If you get 15-20 pips out of it, lock some in, then put your stops just back below this level. Because if you're wrong, you don't want to be too wrong. You know, a nice tight trade, 15-20 ticks, nothing more than that, and maybe get a move up. But on the other side, if you start to see these sort of mini areas taken out to the downside, it means you're probably going to get a push to this low. Then you want to be thinking maybe this top's in place here and we're going to get a steeper pullback. But I don't see any huge moves coming from this, unless a 25 break is really explosive. Give me 1 second, just need to take a glug of water. Right, quick look at gold. So very much a similar pattern to what we're seeing in silver. It's trying to chug through this 60 area. It's making hard work of it, isn't it? You know, when you want to see a break, you want to see a decent break, a decent run through, like what we got here in the 30s. You know, we nudged up, couldn't decide, then boom, off we go. So here it's running into a bit of a traffic zone. This whole area here is a bit of a messy zone. You know, you've got various little highs, areas that have been former support and resistance, you know, around the 70s. So you're looking at maybe a bit of a grind through here. If it's going to continue, then it's going to be a bit of a slow move up. You know, you might get a little pop through 65 or something like that, takes you to 70. Then you have a little bit of a grind up to 80s, then a bit more of a grind up to 86, that sort of thing. Which that sort of price action makes it a bit tougher to trade, because it's not going with much impetus, if you like. And if you want to trade, you want a good tailwind behind you. But this looks like it might just be a grind job. The levels speak for themselves, up to 85, 86, down to 35. So if you don't want to piss around in the middle here, those are the edges you want to wait for. And again, you can either try your shorts for a move back down, or you look for a break trade, because if it breaks these sort of levels, then you might be having a bit of a better run up than you saw messing around in here. But very indecisive is gold at the moment between the levels 86 and 30s, so not too much to grab a hold of there. Horatio says, if China weak economic data means more stimulus from the PBOC and the government, and if Australia jobs and inflation remain strong, then we should be looking at a strong Aussie in the near future. PBOC stimulus is designed to obviously boost the economy. So if that happens, then you're going to see, by nature, by usual rule of thumb, a stronger Aussie dollar. The weaker data does mean that Australia, by definition, should be a bit weaker in the currency. It's not a huge correlation. It's a bit wishy-washy. You know, you do see decent moves on China data in Aussie dollar, just because of their close trading proximity. But I don't think direct PBOC easing is going to impact the Aussie dollar that much. You might, if we get a RRR cut, you're probably going to see a 25 to 40 pip drop in Aussie dollar. Those usually don't really last long. So if you manage to catch one of those, might be worth looking at for a quick fade if you happen to catch the announcement. But it depends what you want to trade it against. If you're trading against the dollar, that's a different kettle of fish altogether, because, you know, not much of this is down to what's going on in China. You know, China's been weak, yet Aussie dollar strengthened all the way to 69. So the China effect not having a big say in that pair, at least. It's all been what's going on in the dollar. You might want to think about something perhaps more local, like Aussie yen, which is obviously doing what the yen is doing, but more from that perspective, that part of the world. Look at that, maybe even against the Kiwi. You know, pick your pairs. Aussie dollar might have a bit more of a move. Oh, what's that doing now? Get rid of that. Might have a bit of a move on a PBOC move than the Kiwi, so you might get a bigger reaction on this one. But again, as you can see there, Aussie is, or China's looking weak, and yet Aussie Kiwi is looking fairly strong in the short term, at least. This one, I'll keep half an eye on it. I have a look just for its cross behavior, and we do seem to be gyrating around this 108 area. We've got a few options expiring today, but I have seen a bit of a pickup in Aussie Kiwi expiries, and it looks like some strategies playing out because they're all spread. Like today, we've got 111, 109, 108.50, 108. Decent numbers, 5, 6, 700s, a billion. And I have seen a bit of a pickup in the options market in this one, in the expiries. But as you can see, we really are sticking like glue to it, this 108 area. Whatever happens, we seem to come back to it. So bit of a magnet, this one. I'm not sure why. As I say, options could be having a big play. I might check that out, actually, look at the next 3 months expiries and see if we've got a lot of action around this 108 area. But definitely acting a bit gluish at the moment. Thank you very much, Shohan, for your kind comment. I hope I'm doing you all proud while on my lonesome. Right, last one, unless you guys do give me something else to talk about. Dollar China. Looks like we might have had, again, similar to dollar yen, a bit of an excessive move lower before we've found a bit of a bottom. This was a zone I was looking at. I wasn't overly keen, just based on the price action, everything going on in trying to catch a knife down here. But it's proved solid enough. This one, probably call it 110, 112 area. But that's where we bounce from there. Yes, the PBOC is still easing. If we do get an RRR cut, then that's probably going to give this one a little boost up. The PBOC themselves, or China officials, have been warning about moves in the yuan, but they're not overly worried about it. They're going to be cautioning against excessive moves, but otherwise, as long as it stays relatively stable, then they're happy. So there is probably room for this to gain again. I might have a look if we get another test down here, depending on the reason why we're down there. Volatility has come out a bit. Now we've seen dollar yen holding up, at least stopping the drop from that. So the dollar side of things was a big influence in this side. But yeah, I like trading this pair because it is very clear. If officials want to put a stop to it, they'll put a stop to it, and you'll know about it, and you'll get the chance to get out. But still, the trend is your friend. We've got a long way before we even put the trend to the test down at 38.2 fib. So yeah, I'll keep a close eye on this one. If we get another move down there and it holds, then perhaps I'll get the butcher's gloves on, as the K-Meister likes to say. Right, enough of me waffling on for nearly an hour. Hopefully you guys and girls are all set up for the day ahead. You know your levels, you know your data that's coming, how to react to it. I want to see you making lots of money from it. Don't want to hear any horror stories. Have a great day, everybody. Big one tomorrow morning from UK CPI, so I might be up early for that one. Buggers, 7 o'clock data. I don't know what's wrong with them. Anyway, have a good day all. Thank you for coming to the Flow Show. See you bright and breezy tomorrow.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.